Welcome to the deep dive. Today, we're diving into the history of American debt. You know how Americans went from basically being wary of owing money to like embracing it?
Like it's a way of life.
Yeah. You gave us some great excerpts from the book Borrow, and we're going to kind of explore all that.
It's fascinating stuff.
Did you know that like mortgage-backed securities and balloon mortgages, those things that caused so much trouble in recent times,
Oh, yeah.
they weren't new inventions. They
Right.
were already causing chaos back in the 1920s.
It's true. Those financial instruments have a long and pretty turbulent history. What's interesting is that the history of debt isn't just like economic trends.
Right.
It's really about how our ideas about like borrowing have changed and shaped individual lives and the entire economy.
Okay, so let's rewind all the way back to the early 20th century. Bardo paints a picture of a time when buying a car on credit was, like, revolutionary.
Huge deal.
It was a huge deal. We take that for granted today, but back then
Oh,
it was a
yeah.
totally different story.
Absolutely. In fact, Henry Ford, the man who, revolutionized car manufacturing,
Right.
was completely against consumer credit. He believed it undermined American independence
Wow.
and weakened the moral character of the people.
Wait, so the company synonymous with cars didn't want people buying their cars on credit.
It's kind of counterintuitive.
That seems so counterintuitive.
It does, doesn't it? Ford's stubbornness on this issue actually contributed to the decline of Ford Motor Company.
Really?
While he clung to this idea of, cash purchases, General Motors
Yeah.
saw an opportunity.
Okay.
They embraced installment buying through their finance arm GMAC,
Okay.
offering consumers more choices and, the flexibility to pay over time.
So GM adapted to the changing consumer landscape while Ford like stayed stuck in his old ways.
Yeah, basically.
What were the long-term ramifications of this shift toward consumer credit?
Well, for one, it marks a fundamental shift in how people viewed debt,
Right.
right? Borrowing money had long been associated with failure and even immorality.
Right, right.
But as the economy grew and income stabilized, a more rationalistic view of debt began to emerge.
Okay.
It was no longer seen as a sign of like personal weakness, but as a calculated risk, part of the engine of economic growth.
So instead of focusing solely on someone's character,
Yeah.
lenders began to look at like their ability to repay.
Precisely. They started assessing borrowers based on their capacity to repay, their income, existing assets, collateral.
Right.
So this is where the four C's of creditworthiness emerged. Character, capacity, capital, collateral,
That's okay.
steady job, reliable income became like the most important factor,
Yeah.
regardless of your background.
It's fascinating how these ideas about creditworthiness like evolved and how they've shaped lending practices over the decades.
It is, and it's worth noting that Ford's deep distrust of financial systems wasn't entirely based on economic principles.
Yeah.
His anti-Semitic views, which were unfortunately common at the time,
Right.
also played a role. He viewed financiers, particularly Jewish financiers, with suspicion, seeing them as manipulators of the system.
Right.
And this prejudice, fueled by the fabricated protocols of the Elders of Zion, further solidified his opposition to consumer credit.
It's a reminder that even innovations like consumer credit, which seem purely economic on the surface, can be influenced by social and cultural biases.
Absolutely.
Hmm.
Now, moving into the 1920s, we see the rise of a familiar villain, the housing bubble.
Ah.
This era saw widespread adoption of interest-only balloon mortgages, which, as you know,
Right.
would come back to haunt us
In the 21st century.
in the 21st century.
So these ticking time bombs, where you make interest-only payments for a few years and then a huge lump sum comes due,
Right.
those are already popular back then.
They were all the rage, especially during the housing boom. The idea was that you'd refinance before the balloon payment came due,
Okay.
hoping that rising property values would cover the cost.
Right.
But, if housing prices dropped or your financial situation changed, you were in big trouble.
Sounds like a recipe for disaster,
Yeah.
especially if a lot of people are relying on this refinancing strategy.
It was, and to make matters worse, lenders were already bundling these mortgages and selling them off as investments, much like the, infamous mortgage-backed securities
Right.
that fueled the 2008 crisis. They were called participation certificates back then, but the underlying principle was the same.
So even back then, investors were buying into these bundles of mortgages without like fully understanding the risks involved.
Yes, and when the bubble burst, the real estate bond market collapsed. mirroring the stock market crash, contributing to the Great Depression.
Well,
Many homeowners, unable to make those balloon payments, lost everything.
that's a stark reminder that history often rhymes, even in the world of finance. The 1920s sound like a time of both, like exciting innovation and dangerous speculation.
Yeah.
Were there any like positive developments that came out of this tumultuous era?
Certainly. The Great Depression, while devastating, also led to some important reforms. It forced policymakers to rethink the role of government in, regulating the financial system
Okay.
and providing a safety net for citizens. One of the most significant outcomes was the creation of the Federal Housing Administration, or FHA.
And the FHA was a game changer
Well,
because...
imagine a world where long-term mortgages were practically unheard of.
Uh,
Bankers back then actually considered it immoral to keep someone in debt
oh, wow.
for an extended period.
Interesting.
The FHA turned that notion on its head.
Okay.
They introduced long-term, fixed-rate mortgages backed by government guarantees,
Wow.
allowing people to borrow money for 15 or even 20 years at a stable interest rate.
So the FHA brought stability and predictability to the housing market, making homeownership accessible to like a wider range of Americans.
Exactly. Their vision was that long-term mortgages would not only help individuals achieve homeownership, but also stabilize the housing market and improve the overall quality of housing stock.
This was a massive departure from the like risky short-term loans that were prevalent before, right?
Absolutely. The FHA's impact went far beyond just increasing homeownership rates. It played a significant role in shaping the suburbs as we know them today. However, these policies also had unintended consequences, particularly in terms of racial segregation through redlining practices.
Right.
These are complex issues we could certainly delve into further.
Yeah, it's incredible how a program designed to address the housing crisis of the Depression ended up having such a profound impact on the social and economic landscape of America.
It really is.
But we'll have to save that conversation for another time.
Yeah, for another time.
For now, we're moving on to the post-war era, where another revolution in consumer credit was brewing.
Indeed. As we enter the 1950s, we see the rise of revolving credit and those iconic department stores taking center stage in this new chapter of American borrowing. Welcome back to our deep dive into the history of American debt.
Last time, we left off with the rise of the Federal Housing Administration during the Great Depression. It's amazing how such a tumultuous period gave rise to innovations that would shape homeownership
No,
for generations to come.
for generations.
But as we move into the post-war era, a whole new chapter begins to unfold.
Right.
And this is where we see those iconic department stores like Macy's and Bloomingdale's.
Yeah.
They were revolutionizing the way Americans shop and borrow.
Yeah.
They were at the forefront of what we now call revolving credit.
That's right. Department stores, they introduced these revolving credit plans, allowing customers to make purchases and pay them off over time, with interest, of course.
Right.
And these plans, they became incredibly popular, fueling the consumer boom of the 1950s. Televisions, appliances, fashionable clothing.
Right.
Suddenly, these items were within reach for millions of Americans,
Yeah.
even if they couldn't afford to pay the full price up front.
It sounds like department stores were really tapping into the aspirations of the post-war consumer. It wasn't just about the products themselves,
Right.
but about the lifestyle they represented.
Precisely. Department stores, they understood the power of aspiration, and they used credit as a tool to create a relationship with their customers.
Yeah.
Building loyalty, encouraging repeat purchases. It was a clever marketing strategy that helped drive their growth during this period.
So these charge accounts,
Yeah.
they were kind of like the gateway drug to the credit card craze that was to come.
That's a great way to put it. The 1950s saw a significant shift in attitudes towards debt.
Okay.
It was no longer seen as something to be avoided at all costs. The tax deductibility of all consumer interest at the time certainly encouraged people to borrow.
Right.
But the real credit card revolution, with those like universally accepted plastic cards we all carry today,
Right.
that was still on the horizon.
While department stores were busy enticing shoppers with charge accounts, a new force was emerging in the retail world. Discount stores.
Yeah.
Places like Walmart, Target, and Kmart were popping up, offering lower prices and shaking up the retail landscape.
Yeah, totally.
How did they approach consumer credit?
Interestingly, many of these early discounters were reluctant to offer credit. It seemed like a step back in time,
Really?
almost a return to like Henry Ford's philosophy of cash purchases.
Wow.
Walmart, for example, focused on keeping prices low, operations lean,
Right.
and they didn't want the added complexity of managing credit programs when they were first starting out.
So while department stores were all about building those customer relationships through credit, discounters were like, nah, you want credit, go get a bank card.
Pretty much. They saw credit as a potential distraction from their core business model, which was all about volume and low margins.
But there were challenges with this approach, right? Barrow mentions the difficulties of repossessing low-value goods bought on installment credit.
Oh, yeah,
It makes sense. The hassle of repossession probably didn't outweigh the value of, like, a pair of pants or a toaster.
exactly. And this realization had a significant impact on uh, how consumer financing evolved.
Yeah.
Companies like GECC, the finance arm of General Electric,
Right.
began to shift their focus. They were no longer solely focused on supporting the sale of, GE appliances.
Okay.
They saw an opportunity to become profit centers in their own right, pioneering private label consumer finance.
So instead of just helping to sell washing machines,
Right.
they were now financing all sorts of consumer purchases
Yes.
through partnerships with retailers.
They started working with retailers to offer credit under the store's brand. So even though a shopper might think they were getting credit from the store, it was actually being provided by a third-party company like GECC.
Interesting.
It was a win-win for both parties.
Right.
Retailers could offer credit without the headaches of managing it themselves, and finance companies like GECC could tap into a much wider market.
It sounds like a clever workaround, but it still seems like there is a gap in the system. The book points out that these early bank credit cards were primarily accessible to the wealthy.
Right.
Working-class consumers were pretty much stuck with retail store credit, which often came with higher interest rates and less flexibility.
That's a crucial point.
Yeah.
The credit landscape was still very much divided along economic lines.
Yeah.
If you didn't have a substantial income and assets, you were unlikely to get approved for a bank credit card.
Right.
So while the wealthy were flashing their diners club and bank cards, a large segment of the population was still excluded from this emerging world of, like, universal credit.
But that's all about to change, isn't it? Barrow talks about this credit card revolution fueled by aggressive marketing tactics like unsolicited mailings and mass marketing campaigns.
Oh, yeah,
It's the dawn of the credit card as we know it.
that's right. Bank Americard and MasterCharge, which would later become Visa and MasterCard,
Right.
entered the scene with a bang. They were determined to get their cards into as many hands as possible, pushing the boundaries of traditional lending practices.
They were really pushing the envelope. Wasn't there some sort of credit card fiasco in Chicago back in 1966?
Oh, yeah.
Where banks just flooded the market with unsolicited credit cards?
Yeah.
What happened there?
It was quite a debacle. A group of banks in Chicago, they decided to launch this massive credit card campaign,
Okay.
mailing out millions of cards to people who hadn't even applied for them.
Wow.
It was a bold move,
Yeah.
but it backfired spectacularly.
I can imagine. What could possibly go wrong with sending out millions of credit cards to random people?
Well, for starters, they didn't do a very good job of vetting the recipients, right? They were so eager to get those cards out there that they weren't adequately checking credit histories
Oh, wow.
or looking for duplicate mailings.
Wow.
Some people received a dozen cards or more,
Really?
including some addressed to their children. It was a free-for-all. And to make matters worse, they announced the mass mailing in advance,
Oh, no.
which tipped off some of Chicago's less than law-abiding citizens.
I bet they had a field day.
They did. There were reports of cards being stolen from mailboxes
Oh, gosh.
and even mailrooms. Organized crime got involved, using stolen cards to rack up charges under $50, which was the threshold for verification at the time. It was a chaotic situation that exposed some major flaws in the system.
So this whole Chicago debacle, it was a major wake-up call for the banking industry.
It was. It highlighted the risks of mass marketing credit cards without proper safeguards.
Oh.
But on the positive side,
Okay.
this fiasco spurred the development and adoption of important security features like the magnetic stripe,
Okay.
which helped to improve fraud prevention and make credit cards more secure.
So even though there were some missteps along the way,
Yeah.
the credit card revolution was marching onward,
Oh.
transforming the way Americans used credit.
Absolutely. As these nationwide credit card networks grew,
Right.
we see this shift from short-term repayment to longer-term revolving debt.
Okay.
People were no longer paying off their balances each month.
Right.
They were starting to carry balances and pay interest, which became a lucrative source of revenue for the banks.
It sounds like the credit card was becoming more than just a convenient payment tool.
Yeah,
It was starting to reshape spending habits and attitudes towards debt.
exactly. And as we'll explore in the final part of our deep dive, this trend only intensified in the decades that followed, setting the stage for the housing bubble, the financial crisis, and, the complex challenges we face today.
We're back for the final part of our deep dive into the history of American debt. And we've seen how borrowing has evolved from like a taboo subject
Yeah.
to a driving force in our economy.
It's been quite a journey from, Henry Ford's aversion to credit to the rise of those ubiquitous credit cards.
And now we're going to tackle the era leading up to the 2008 financial crisis, a period I think a lot of us remember
Oh, yeah.
all too well.
It's crucial to understand that the seeds of that crisis were sown decades earlier
Right.
as securitization and the allure of, easy credit gained momentum.
The book really highlights how securitization played this huge role in fueling the housing bubble of the 2000s. It's almost like this financial alchemy, turning mortgages into these like tradable securities that seemed like magic money.
It did feel like magic for a while, didn't it?
Yeah.
Global capital was pouring into mortgage-backed securities, driving down interest rates, making homeownership seem within reach for just about anyone.
But as we know, there's a dark side to this kind of magic. What were some of the factors that turned this financial innovation into like a recipe for disaster?
Well, one crucial factor was the relaxation of lending standards, right?
Yeah.
Lenders were handing out mortgages to people with, shaky credit histories, low incomes, often with little or no documentation required.
Oh, wow.
These subprime mortgages, as they were called,
Right.
were bundled into those mortgage-backed securities
Okay,
and
yeah.
sold to investors who, frankly, didn't always fully understand the risks involved.
And the credit rating agencies, weren't they supposed to be the watchdogs assessing the risk of these securities?
You would think so, wouldn't you?
Yeah.
But unfortunately, they were giving these risky mortgage-backed securities like top ratings,
Wow.
creating a false sense of security that led to, a massive misallocation of capital.
It's almost as if we had collectively forgotten the lessons of the 1920s with those dangerous balloon mortgages and the collapse of the real estate bond market. Do you see any parallels between those two eras?
Absolutely. In
Yeah.
both cases, you had this potent cocktail of easy credit, lax lending standards, and speculative fervor, fueled by the belief that housing prices would just keep rising indefinitely.
Right.
And when the bubble burst, as it inevitably does,
Right.
the consequences were devastating.
Millions of people lost their homes, the financial system teetered on the brink, and the global economy plunged into recession. It was a painful reminder that there's no such thing as a free lunch, especially when it comes to debt.
Indeed. The 2008 crisis was a stark reminder that financial innovation, while often beneficial, can also have unintended consequences,
Right.
especially when coupled with inadequate regulation and oversight.
But the book goes beyond just pointing fingers at, greedy bankers or
Right.
reckless borrowers.
Yeah.
It suggests that there were like deeper structural issues at play. Right.
That's right. The book argues that the crisis exposed this growing imbalance between uh, productive investment and speculative finance.
Yeah.
Instead of channeling capital into, businesses that create jobs and goods,
Right.
we were pouring trillions of dollars into this housing bubble,
Yeah.
inflating asset prices, and creating a system that was ultimately unsustainable.
It's like we became addicted to easy credit, both as consumers and as investors. We were living beyond our means, borrowing against the future with this assumption that the good times would just keep rolling.
That's a powerful analogy. And as the book suggests, breaking free from this cycle of debt-fueled booms and busts requires a fundamental shift in our thinking about debt, risk, and the role of finance in society.
So where do we go from here? What can we learn from this deep dive into the history of American debt? Are there any like glimmers of hope, any potential solutions that might help us create a more stable and equitable financial system?
The book offers some thought-provoking ideas. It suggests that instead of simply focusing on, regulating borrowers, we need to think more creatively about how to encourage productive investment, channeling capital into businesses and projects that, generate real economic value.
So rather than trying to like curb consumer spending
Right.
or limit access to credit, we should focus on making sure that credit is being used to fuel sustainable growth and innovation.
Precisely. The book proposes some bold ideas, such as the creation of a new federal agency modeled after the FHA, but focused on supporting small businesses.
Okay.
Imagine if we could securitize small business loans, making it easier for entrepreneurs to access the capital they need to grow and create jobs.
That's a fascinating idea. If securitization can channel trillions of dollars into the housing market, as we've seen, couldn't it be harnessed to support a more vibrant and dynamic small business sector?
That's the question the book poses. It's a call for innovation, for a more thoughtful and strategic approach to finance, recognizing both its power and its potential pitfalls.
We've covered a lot of ground in this deep dive, from the early days of installment buying to the rise of credit cards and the complexities of securitization. It's clear that the story of American debt is far from over.
It's a story that continues to unfold, shaped by our choices and the systems we create. The relationship between Americans and debt is complex and ever evolving. Understanding this history is crucial for making, informed decisions, both as individuals and as a society.
We've learned about the allure of easy credit, the dangers of unchecked speculation, and the potential for financial innovation to both solve problems and create new ones. As you continue to explore this topic, consider this. What role do you want debt to play in your life? And what kind of financial system do we want to build for the future?
These are questions worth pondering, and as we've seen today, history can offer valuable insights as we navigate the complexities of debt in the 21st century.
Thanks for joining us on this deep dive. Until next time, happy learning.